One of the first things you have to learn is the difference between a positive and a normative economic statement. A positive economic statement are precise, fact-based statements that can be proven or disproven by data. For example, saying a rise in unemployment will lead to a decline in average household income is a positive statement. This can be tested and proven by looking at economic data, which makes it positive. A normative economic statement is more like an opinion because it is based on the values and beliefs of the person making the statement. For example, you may think the government should remove the USC tax in Ireland to increase demand in the economy. Statements like this are mostly opinions because there is no clear data that can definitely prove what the government should do. Let's look now about the concepts of scarcity, choice, and opportunity cost. We can start with the definition of scarcity. Scarcity refers to the gap between limited resources and unlimited wants. The term scarce resources refers to the limited supply of the factors of productions compared to our limited demand for them. This leads us directly to the definitions of economics itself. Economics is a social science. A social science is a science that studies human behavior. Examples include political science, which studies power dynamics, anthropology, which studies past cultures, and economics, which studies how limited resources are used to satisfy our limited wants and needs. To go a bit deeper into scarcity, basically means that everyone has limited wants. You might want to buy a lot of chocolate, cars, or houses, but you have limited resources, which is the amount of money you have. Another core definition to learn is opportunity cost. Opportunity cost is the next best alternative forgone when a choice is made. For example, imagine a scenario where you have 20 euros to spend and there are two things you want, a video game or a cinema ticket. If you choose to buy the video game, the opportunity cost is the cinema experience you have to give up. This concept doesn't just apply to individuals, but it also applies to governments and firms when they have to make budget decisions. In order to influence consumers and firms, governments use incentives and regulations. An incentive is something that motivates a firm or individual into behaving in a certain way. A regulation, on the other hand, is a law or a rule that must be followed. Breaking regulations results in penalties or fines. Specialization is a key concept, which basically means that in order to be efficient in what you do, you should focus on a specific part of a process or an area. For example, to be a better student, you might choose to set amount of subjects and clubs to focus so you don't have to overload yourself, allowing you to do better in those specific areas. That is personal specialization. The exact economic definition that you have to learn is: specialization of labor refers to the separation of work process into a number of tasks, with each task being carried out by a separate group of workers. Of course, there are pros and cons to this. Advantages include increased efficiency, higher productivity, and lower production costs. Disadvantages include the loss of motivations for workers during repetitive tasks, fewer chances of promotion, and workers ending up with a very small, narrow set of skills. Now let's talk about the two main areas of economics. Microeconomics analyzes the behavior and decisions of individuals and firms, while macroeconomics studies the behavior and decisions of governments and countries looking at the economy as a whole. The PPF, to explain it simply, is a graph used to analyze how a firm with limited resources can produce two different products. The curved line you see on the graph indicates the scenario where all the resources are being fully and efficiently used. The further up and left you go on the curve, the more of product Y you produce. The further down and right you go, the more of product X you produce. Any point inside the curve represents an efficient use of resources, meaning some resources are being wasted. Any point outside the curve is currently impossible to achieve because the firm simply doesn't have enough resources.